I'm watching something unfold right now that most people won't see until it's too late. And when they do see it, their paper wealth will have already evaporated. Let me show you exactly what I'm talking about. There's a window closing, not in months, not in weeks. We're talking about a very narrow time frame where you can still move your wealth from paper assets into hard assets before the crowd realizes what's happening. And once the crowd figures it out, the opportunity disappears. Here's what's happening behind the scenes. Central banks around the world are quietly accumulating physical gold at a pace we haven't seen in decades. They're not buying paper gold. They're not buying gold ETFs. They're taking delivery of actual physical metal and storing it in their vaults. Why? Because they know something that most retail investors haven't figured out yet. The gap between paper assets and hard assets is about to widen dramatically, and I'm going to show you exactly why this is happening, what it means for your wealth, and most importantly, what you need to do about it right now. Let's start with what's actually happening in the gold market. Gold has been climbing steadily, breaking through resistance levels that held for years. But here's what most people miss. The price you see quoted on financial news, that's the paper price. That's the price of gold futures contracts, gold ETFs, and other derivative products. The physical market is telling a completely different story. When you try to buy physical gold right now, you're paying premiums that are significantly higher than the spot price. Dealers are charging anywhere from 5 to 15% over spot for common bullion products. Some specialty items are commanding even higher premiums. Why? Because there's a shortage of physical metal available for immediate delivery. Think about what that means. The paper market says gold is trading at one price. But if you actually want to hold physical metal in your hand, you're paying substantially more. That spread is telling you something critical. It's telling you that the paper market and the physical market are starting to disconnect. Now let me show you what's driving this. Industrial demand for silver has been absolutely exploding. Solar panels, electric vehicles, electronics, medical devices, all of these industries need silver, and they need physical silver, not paper contracts. You can't build a solar panel with a silver ETF. You need actual metal. At the same time, mining production hasn't kept pace. Most silver comes as a byproduct of other mining operations. When copper mines slow down, silver production drops. When lead and zinc operations cut back, less silver comes to market. And right now, we're seeing production constraints across the board. But here's where it gets really interesting. Look at what's happening with silver inventories at the COMEX. These are the warehouses where physical silver is stored to back futures contracts. Those inventories have been declining steadily, not dramatically, not in a way that makes headlines, but consistently, month after month, the amount of physical silver available for delivery has been shrinking. Quick note before we go further. If you're watching this and you're concerned about protecting your wealth, I put together a free guide that shows the saving secrets thousands of American retirees are using to protect their hard-earned wealth. It's in the description below. Covers strategies most people never hear about. Worth checking out. Now back to what's happening with these inventories. When you have declining physical inventories, while paper contracts keep getting created, you're setting up a situation where the system becomes increasingly fragile. It's like a bank that keeps writing checks while its vault gets emptier and emptier. Eventually, someone's going to show up and want their money, and the bank won't have it. We've seen this movie before. Let me take you back to a moment in history that most people have forgotten. It was the early 1970s, and the United States was running a system where foreign governments could exchange their dollars for gold at a fixed rate, $35 per ounce. That was the deal. But there was a problem. The US was printing more dollars than it had gold to back them. Other countries started to notice. France sent a warship to New York Harbor to pick up their gold. Germany started asking questions. Switzerland wanted their metal. And the US government realized they had a choice. Either honor the commitment and watch the gold reserves disappear, or change the rules. They changed the rules. Nixon closed the gold window. Suddenly, all those dollars that were supposedly backed by gold were just paper. And what happened to the gold price? It went from $35 an ounce to over $800 within a decade. The people who held paper dollars watched their purchasing power evaporate. The people who held physical gold preserved their wealth and then some. We're seeing the same pattern develop right now, just in a different form. The paper gold market has grown to a size that's completely disconnected from the physical market. For every ounce of physical gold that exists, there are multiple claims on that same ounce through futures contracts, ETFs, and other paper instruments. It's the same game, just with more sophisticated players and more complex instruments. Here's what makes this situation even more precarious. The derivatives market for precious metals has exploded. Banks and financial institutions have created a web of contracts, swaps, and options that all reference the price of gold and silver. But these contracts don't require physical delivery. They're settled in cash. So you can have massive trading volume, huge price swings, and very little actual metal changing hands. This creates an illusion of liquidity. It looks like there's plenty of gold and silver available because you can trade these paper contracts all day long. But what happens when people start demanding physical delivery? What happens when investors decide they don't want a contract that promises them gold? They want the actual metal. We're starting to see the early signs of this shift. Wealthy individuals are buying physical gold and storing it in private vaults. Family offices are allocating larger percentages of their portfolios to hard assets. Sovereign wealth funds are taking delivery of physical metal. These aren't speculators making short-term bets. These are sophisticated investors making long-term strategic decisions about wealth preservation. And they're doing it quietly. You won't see press releases. You won't see headlines. But if you know where to look, you can see the evidence. Vault construction is booming in Switzerland and Singapore. Private storage facilities are expanding. Armored transport companies are reporting record business. The smart money is moving, and they're moving into physical assets. Now let's talk about what's happening with the dollar. The US dollar has been the world's reserve currency for decades. That status has given the United States enormous advantages. We can print money and export inflation to the rest of the world. We can run massive deficits because other countries need dollars to conduct international trade. It's been an incredible privilege. But that privilege is being challenged. Countries around the world are starting to conduct trade in their own currencies, bypassing the dollar entirely. China and Russia have been settling oil transactions in yuan and rubles. India is buying oil from Russia using rupees. Saudi Arabia is discussing pricing oil in currencies other than dollars. These aren't just headlines. These are fundamental shifts in the global monetary system. What does this mean for your wealth? If the dollar loses its reserve currency status, even partially, the amount of dollars that other countries need to hold drops dramatically. All those dollars that have been sitting in foreign central banks and sovereign wealth funds could come flooding back to the United States. That's inflation on a scale most Americans have never experienced. And here's the thing, you can't protect yourself from that kind of inflation with traditional paper assets. Stocks might go up in nominal terms, but if the dollar is losing value rapidly, your real purchasing power is still declining. Bonds are even worse. You're locked into receiving payments in a currency that's depreciating. Real estate can help, but it's not liquid, and it comes with property taxes that rise along with inflation. Hard assets are different. Gold and silver have been stores of value for thousands of years. They've survived the collapse of every fiat currency in history. When paper money fails, people turn to precious metals. It's happened in Weimar Germany, in Zimbabwe, in Venezuela, in Argentina. Every single time, the people who held physical gold and silver preserved their wealth while paper assets became worthless. But here's what most people don't understand. The time to move into hard assets isn't after the crisis hits, it's before. Once everyone realizes what's happening, the premiums on physical metal skyrocket. Dealers run out of inventory. Wait times for delivery stretch from days to weeks to months. And if the crisis is severe enough, you might not be able to get physical metal at any price. That's the window I'm talking about. Right now, you can still buy physical gold and silver. Yes, you're paying premiums over spot, but you can get metal delivered to your door within a reasonable time frame. That window won't stay open forever. Let me show you what happens when that window closes. Go back to 2008, during the financial crisis. As Lehman Brothers collapsed and the banking system teetered on the edge, something interesting happened in the precious metals market. The paper price of gold actually dropped initially. Hedge funds were liquidating everything to raise cash. Margin calls were forcing sales. On paper, it looked like gold was falling. But try to buy physical gold during that time. Dealers were completely sold out. The US Mint suspended sales of gold and silver eagles because they couldn't keep up with demand. Premiums on available products went through the roof. People were paying 30, 40, even 50% over spot just to get their hands on physical metal. So you had this bizarre situation where the paper price was dropping, but the real price, the price you actually had to pay to own physical metal, was soaring. The two markets had completely disconnected, and the people who waited until the crisis hit to buy gold found themselves either unable to get metal or paying massive premiums. We're setting up for the same thing to happen again, except this time it could be much worse. The amount of paper claims on physical metal is higher than it was in 2008. The financial system is more leveraged, the derivatives market is larger, and the geopolitical tensions are more severe. Think about what's happening right now on the world stage. We have major powers challenging the existing world order. We have trade wars and tariff battles. We have sanctions and counter-sanctions. We have military tensions in multiple regions. All of this creates uncertainty, and uncertainty drives people towards safe haven assets. But here's the critical point. Most people are still holding their wealth in paper assets. Their retirement accounts are in stocks and bonds. Their savings are in bank accounts, earning minimal interest. They're completely exposed to the risks we're talking about, and they don't even realize it. Now, if you're sitting on retirement savings and you're concerned about what we're discussing, there's something you should know. If you have $100,000 or more in retirement accounts, there are ways to get physical gold into those accounts without triggering tax penalties. I put together a guide on how gold IRAs work. It's in the description. Covers the mechanics, the rules, the strategies. Worth looking at if you're thinking about protecting your retirement savings from what's coming. These accounts let you hold actual physical metal, not paper contracts, within a tax-advantaged structure. Something to consider as you're thinking about wealth preservation. Anyway, let me show you what's happening with silver specifically, because silver is setting up for something potentially explosive. Silver has this unique characteristic where it's both a monetary metal and an industrial metal. Gold is primarily monetary. Platinum is primarily industrial. But silver sits in both camps. That creates a situation where silver demand is being driven by two completely different forces. On the monetary side, you have investors buying silver as a hedge against inflation and currency debasement. On the industrial side, you have manufacturers who need silver for production. They're not buying it as an investment. They need it to make their products. When both of these demand sources are strong at the same time, you get a supply crunch. And that's exactly what we're seeing right now. Investment demand is rising as people get nervous about the economy and the currency. Industrial demand is rising as the green energy transition requires more and more silver, and supply isn't keeping up. Here's a number that should get your attention. The solar industry alone is projected to consume massive amounts of silver over the next decade. Every solar panel requires silver for the electrical contacts. As countries push for renewable energy, that demand is only going to increase. And unlike investment demand, which can fluctuate, industrial demand is relatively inelastic. If you're building solar panels, you need silver. There's no substitute that works as well. Now layer on top of that the demand from electric vehicles. Silver is used in EV charging stations, in the vehicles themselves, in the infrastructure that supports the EV ecosystem. As the automotive industry transitions to electric, silver demand from that sector is climbing rapidly. And then you have electronics. Every smartphone, every computer, every electronic device uses silver. As the world becomes more connected, as the Internet of Things expands, as 5G networks roll out, the demand for silver in electronics keeps growing. All of this industrial demand is happening while above-ground silver inventories are declining. Unlike gold, which mostly sits in vaults after it's mined, silver gets consumed. It's used in industrial applications where it's not economically viable to recover it. Once it's in a solar panel or an electronic device, it's essentially gone from the available supply. This creates a fundamentally different dynamic than gold. With gold, almost every ounce ever mined still exists in some form. It might be in jewelry, in bars, in coins, but it's still around. With silver, a significant portion of what's been mined has been consumed and dispersed. The above-ground supply is actually shrinking while demand is growing. What happens when you have shrinking supply and growing demand? Economics 101 tells you the price has to rise. But the paper market has been suppressing that price discovery mechanism. Through futures, contracts, and derivatives, Large institutions can create selling pressure without actually having to deliver physical metal. They can keep the paper price contained even as the physical market tightens. But that game can only continue as long as people are willing to accept paper claims instead of demanding physical delivery. And we're starting to see cracks in that system. More investors are asking for physical delivery. More industrial users are securing long-term supply contracts. More countries are building strategic reserves of physical metal. When the paper market finally breaks, and it will break, the price adjustment is going to be swift and dramatic. We're not talking about a gradual rise. We're talking about the kind of move that happens over days or weeks, not months or years. And by the time most people realize what's happening, the opportunity to buy physical metal at reasonable prices will be gone. Let me give you a historical parallel. In 1979 and 1980, silver went from around $6 an ounce to over $50 an ounce in a matter of months. What drove that? The Hunt brothers were trying to corner the silver market, but they were also responding to real supply and demand fundamentals. Inflation was raging, the dollar was weak, industrial demand was strong, and the price exploded. Now, I'm not predicting we're going to see that exact scenario play out again, but I am saying that the fundamentals today are in some ways even more compelling than they were back then. We have larger industrial demand, we have more currency uncertainty, we have a bigger derivatives market that's more disconnected from physical reality. All the ingredients are there for a significant price move. And here's what most people miss. When these moves happen in precious metals, they don't follow a nice, smooth upward trajectory. They happen in bursts. You'll see the price consolidate for months or even years, and then suddenly it gaps up dramatically. If you're not already positioned when those gaps happen, you miss the move. That's why the window we're talking about is so critical. Right now, you can still accumulate physical metal. You can still build a position. You can still protect your wealth before the crowd figures out what's happening. But once the move starts, once the price begins to gap up, trying to buy physical metal becomes exponentially more difficult and expensive. Think about your own situation for a moment. How much of your wealth is in paper assets? How much is in hard assets? If the dollar loses significant value, if the stock market corrects, if bonds default, what happens to your net worth? Are you protected or are you exposed? Most people are completely exposed and they don't even realize it. They think their diversified portfolio of stocks and bonds is safe. They think their money market account is protecting them. They think their retirement account is secure. But all of those assets are denominated in dollars. All of them are paper claims. And if the dollar itself is the problem, those assets aren't going to protect you. This is why wealthy families have always held a portion of their wealth in hard assets. It's not because they're pessimistic. It's because they understand that paper assets and hard assets serve different purposes. Paper assets are for growth. Hard assets are for preservation. You need both. But the ratio between the two should shift based on the environment you're in. When the financial system is stable, when currencies are sound, when geopolitical tensions are low, you can afford to hold more paper assets. But when you see the warning signs we're seeing now, when you see the cracks forming in the system, that's when you need to shift more of your wealth into hard assets. And the shift needs to happen before the crisis, not during it. During a crisis, everyone is trying to do the same thing at the same time. They're all trying to sell their paper assets and buy hard assets. That's when you get the massive price dislocations. That's when you see paper assets collapse in value while hard assets soar. The smart money doesn't wait for the crisis. They position themselves ahead of time. They see the warning signs and they act. And right now, the warning signs are everywhere if you know where to look. Look at what central banks are doing. They're not just buying gold, they're repatriating gold from foreign vaults. Germany brought hundreds of tons of gold back from New York and Paris. The Netherlands did the same. Austria, Belgium, and other countries have been quietly moving their gold reserves back home. Why? Because they want physical possession. They want to make sure that if something goes wrong in the financial system, they have their gold in their own vaults, under their own control. That should tell you something. These are sophisticated institutions with access to the best information and analysis available. And they're choosing to hold physical metal in their own possession rather than trusting paper claims or foreign storage. They're preparing for a scenario where counterparty risk matters, where the ability to actually take possession of your assets becomes critical. Now think about what that means for individual investors. If central banks are worried about counterparty risk, if they're worried about being able to access their gold when they need it, shouldn't you be thinking about the same things? If you own gold through an ETF, do you actually own gold, or do you own shares in a fund that owns gold? If the system breaks down, can you take delivery of physical metal, or are you just holding a paper claim? These are the questions you need to be asking right now. And the answers should inform how you position your wealth, because the window for moving from paper to physical is closing. Not because I say so, but because the fundamentals are forcing it to close. Every day, more industrial silver gets consumed. Every day, more investors wake up to what's happening. Every day, the gap between paper claims and physical metal gets wider. And every day, the risk of a disorderly repricing gets higher. When that repricing happens, it's going to catch most people completely off guard. They're going to wake up one morning and see that gold and silver have gapped up dramatically overnight. They're going to rush to buy physical metal and find that dealers are sold out or charging massive premiums. They're going to realize that their paper assets are losing value while hard assets are soaring. And they're going to wish they had acted when they had the chance. Don't be that person. Don't wait until everyone else figures it out. The whole point of understanding these market dynamics is to position yourself ahead of the crowd, not to follow them. Here's what I want you to take away from this. We are in a unique moment where paper assets and hard assets are still trading at prices that don't reflect the underlying reality. The paper market is still functioning. You can still buy physical metal. The window is still open, but it won't stay open forever. The forces that are going to close that window are already in motion. Industrial demand is rising. Investment demand is rising. Supply is constrained. Central banks are accumulating. Geopolitical tensions are increasing. Currency debasement is accelerating. All of these factors are pushing toward the same outcome, a significant repricing of hard assets relative to paper assets. The question isn't whether this repricing is going to happen. The question is when, and whether you're going to be positioned for it or caught off guard by it. And the answer to that question depends on what you do right now, while you still have the opportunity to act. So here's my challenge to you. Take a hard look at your portfolio. Calculate how much of your wealth is in paper assets versus hard assets. Think about what would happen to your net worth if the dollar lost significant value. Think about what would happen if the stock market corrected. Think about what would happen if you couldn't access your bank accounts or your brokerage accounts for an extended period. Are you comfortable with your level of exposure, or do you need to make some adjustments? Because the time to make those adjustments is now, while you still can, while the window is still open, while you can still move your wealth from paper into hard assets at prices that make sense. The wealthy families who have preserved their wealth across generations didn't do it by following the crowd. They did it by understanding market cycles, by recognizing when the environment was changing, and by positioning themselves accordingly. They understood that there are times to hold paper assets and times to hold hard assets, and they had the discipline to make the shift when the fundamentals called for it. We're at one of those inflection points right now. The fundamentals are screaming that it's time to shift more wealth into hard assets. The question is whether you're going to listen to what the fundamentals are telling you, or whether you're going to wait until everyone else figures it out and the opportunity is gone. I've shown you what's happening in the markets. I've shown you what central banks are doing. I've shown you what the smart money is doing. I've shown you the historical parallels. I've shown you the supply and demand dynamics. All the evidence points in the same direction. The window for moving from paper to hard assets is closing, and it's closing fast. What you do with that information is up to you. But I'll tell you this, years from now, you're going to look back at this moment and you're going to either be glad you acted or you're going to wish you had. The choice is yours, but the window won't stay open forever. And if you've watched this far, you're clearly serious about protecting your wealth. Remember that free guide I mentioned? It's in the description. And here's something most people don't know. If you're an American retiree with at least $100,000 in any retirement account, you can get an exclusive one-on-one educational web conference, completely free, no obligation. Just mention you watched this video. It's only available to people who meet those criteria, but if that's you, it's worth taking advantage of. The education alone could be invaluable for your financial future. The bottom line is this. We're living through a historic shift in the global monetary system. The old order is breaking down. A new order is emerging. And in that transition, the people who hold paper wealth are going to see that wealth evaporate, while the people who hold hard assets are going to preserve and grow their wealth. The window to make that shift is still open, but it's closing. The question is, are you going to walk through it while you still can?